Welcome back. You're watching Markets at Noon and looking at the stock market on the Friday session. Well, we had 3 sessions of up moves and now we have surrendered onto those gains. And at present, even lower than 25,300 as where you see Nifty around 125 points of downtrends over there. The benchmarks, both Nifty as well as Bank Nifty, showing signs of volatility. It's a profit booking phase after 3 sessions of positivity. Of course, the market participants are not willing to take bets and go on the weekend. However, if you have a look at the global setup and the developments on the tariff front, also the representatives of US and India are doing the talks and we might see some conclusion. But quickly talking about the stocks which are doing good in trade, it's the Adani Group. While it has got a clean sheet from SEBI and the SEBI calls the Hindenburg claims baseless. So Adani Group stocks literally from 2.5% to 6, 7, even 8%. A few stocks like Adani Power are ranging quite good, around whopping 8% of upsurge in Adani Power at present. But then what are the long-term fundamentals of the market? Let us try and understand that as well, because along with the technicals, the fundamentals matter a lot as well. To talk on the same, we have Christy Mathai, Fund Manager, Equity Quantum AMC with us. Christy, thank you for joining in. It's a pleasure talking to you this afternoon. A lot of factors are affecting the market at present, impacting the market at present. How do you see the market considering the global triggers as well as the triggers on the domestic front? You see the GST rate rationalization as a boost. The US-India trade talks and some conclusion, hopes of some conclusion is again a hope which we are wanting. How do you see the texture of the market?
Yeah, thanks. Thanks for having me. So clearly, there are some tailwinds if you were to just look at the Indian macro per se. You've seen the tax cuts, you've seen the GST reduction, the monetary policy-wise, there has been a lot of liquidity infusion, which is pretty good for the banking system as a whole. And when we look at some of the key lead indicators, we have seen possibly the credit growth is possibly picking up from the very lows that we have had in the recent past. If you just look at the latest numbers, though it is much below the overall trend line. So our expectations for the market is from broadly at this point in time, given the correction that we have had in the past few months, when we look at our individual portfolio companies, we are fairly optimistic going ahead. Broadly, in a sense, like, compared to the past 2, 3 months, the possibility of getting a better returns from the market has substantially increased, especially in the large cap pockets. And, in the near term, you might have possibly a weak quarter given, where things are, especially with respect to GST implementation and things like that. But when you're looking at the second half in FY27, we are much more optimistic, especially on the earnings print.
Right. Christy, hi, Ankur this side. I want to understand your view on the sectors now. But before I come to specific sectors, I want to understand the dynamics of telecom sector per se. You would have seen the news which has just come from Supreme Court regarding Vodafone AGR dues. But more importantly, if a window opens on this AGR calculation which has been going on for 4 to 5 years, do you think there might be re-rating in the sector?
See, clearly, if you look at the telecom sector, we do have some exposure to the sector, and it has done pretty well. Just basis the ARPU growth that we have seen in the past 2 years. Now, the way things work is this ARPU growth has kind of flowed to the directly to the bottom line, and you have seen a fair bit of FCF generation from majority of these names. And clearly, what holds good for one company holds good for the others as well. But if you look at the spectrum, like AGR dues and things like that, for the larger names, possibly which we own, it is not a major component in terms of their debt payments and things like that. So it is a manageable situation. We do not expect a possible re-rating because of this. It can happen in some pockets, maybe in a smaller name. But the point is, given where the valuations are, it has moved substantially higher in the past, let's say about a year or so. And if you look at the subscriber growth, there things are plateaued. Possibly you can have some premiumization that going ahead. But broadly, when we are looking at the structure sector, it will generate a lot of free cash flows. And there is no immediate requirement in terms of a capex, which the companies have to put down. So broadly, things are balanced given the valuation which has moved ahead. So we are constructive on the sector, but we don't see a possibility for re-rating. Possibly you can have some EPS compounding in the sector.
Okay, Christy, also, what is your philosophy while you consider investment, and at the same time, any preferred stocks and sectors, stocks if you would want to share?
Right, sure. So our core investment philosophy is buying liquid names, companies which fit our governance filters and buying at a discount to its intrinsic value, which could be at a minimum 25%. So if you are able to buy these companies at a minimum 25% or more discount, going ahead, when the company realizes its intrinsic value in the, let's say 2 year out or 3 year out, what we'll have is a steady compounding that one can generate. And that's pretty simple. And that's what we're trying to do. So the sectors that sort of fit the bill at this juncture clearly are, the financial space. When you look at the banking names, especially the private banks, this is one of the pockets where we should expect a reasonably good earnings print, especially if we move to FY 27, 28, especially 27, because, at the current juncture, you might have NIM pressures because, the repricing is happening, especially of the asset base faster than the liabilities. So that might put an impression. But going ahead, when the credit costs have also normalized, once these things settle, you should see a earnings growth coming through for the sector. So we are fairly positive on that sector, and it sort of fits in our broader spectrum of buying it at cheaper than the intrinsic value. The other sector is, which is not so popular at the moment, is IT services, which is in kind of a headwind from the start of the year. But from our perspective, you have to be patient in this sector because you've almost had 3 years of broadly no great spend coming through to the IT services, which should pick up at some point in time. And we are sort of fairly well positioned. So outside of this, we do have exposure to the discretionary pockets such as autos, uh, where we think the volume recovery is possibly going to happen, especially on the two-wheeler segment. So these are a broader sector allocations and where we are sort of overweight compared to the index.
Right, Christy, thank you so much for joining this hour with your views.